Monday, March 30th, 2026. The United States Department of Labor dropped 160 pages of new rules onto the Federal Register. The headline used one word that should make you nervous: democratize. The government wants to democratize your retirement account. That means private equity, private credit, cryptocurrency, and hedge funds, all of it cleared for landing inside your 401k. $10.1 trillion sitting in those plans right now, 70 million workers. That is not a policy number. That is the combined life savings of half the American workforce, packed into accounts most people check twice a year. And here's the part that should stop you cold. The moment the announcement hit, Blackstone shares jumped. KKR jumped. Apollo jumped. The biggest private equity firms on the planet watched a rule written for American workers, and their stock prices climbed. They did not celebrate because you got a better deal. They celebrated because they got access to your money. Let me show you why. Here is how private equity works. A firm raises a fund. It collects money from investors, pension funds, endowments, wealthy families. Then it borrows more, sometimes $2 or $3 of debt for every dollar of equity. It uses all that cash to buy a company. It holds that company for 5, 6, 7 years, cuts costs, restructures operations, loads on debt, then it sells. If the sale price beats the purchase price, the fund takes a cut. That cut has two parts. First, a management fee. The industry average right now is 1.6% of all money in the fund. Every single year, whether the fund makes money or loses it, you pay that fee while you wait, while the fund goes sideways, while the fund goes down. Second, a performance fee called carried interest. 20% of all profits above a certain threshold go straight to the fund manager. Not to you, to them. Now compare that to what most 401k investors already own. A basic S&P 500 index fund charges 0.03% per year. So let us show the math. 1.6 divided by 0.03 equals 53.3. Private equity charges 53 times more than an index fund. Before anyone earns a single dollar of return, the fee machine has already taken its share. That is not a rounding error. That is a completely different business model, one built to pay the manager first and the investor second. But fees are only half the problem. The other half is the door, a locked door. When you own a stock or an index fund, you can sell it in seconds. You see the price on your screen. You press a button, cash hits your account by the next morning. Private equity does not work that way. When your money enters a PE fund, it is locked behind a gate with no handle on the inside. The average holding period for a private equity deal at exit is now 7 years. There is no daily price. There is no transparent market. There is no exchange. The fund manager decides what the investment is worth on paper once a quarter using models the manager built. And the fund manager decides when or whether you get your money back. For a massive pension fund with a 50-year time horizon and a team of analysts on staff, that illiquidity might be tolerable. For a worker who turns 62 and wants to retire next spring, it is a trap. Your money exists on a quarterly statement. But you cannot touch it, move it, or spend it when you need it most. Nobody at the Department of Labor mentioned that part on Monday. You might be thinking this is still worth it if the returns are high enough. A little illiquidity for a lot of upside. Higher risk, higher reward. That is exactly what the industry has been selling for 30 years. And for most of that time, big institutional investors bought it. But here is what changed. The returns stopped showing up. The exits stopped happening. And now private equity has a problem it cannot solve with leverage or restructuring. It cannot sell what it already owns. So it needs fresh money from a new source. A source that has never seen the inside of a PE pitch deck, never negotiated a fee, and cannot walk away once the check clears. That source is you. This is not about giving workers access to better investments. This is about giving a trapped industry access to workers' cash. Let me show you the numbers, and let me show you the pattern. Private equity once beat the stock market consistently. That era is over. MSCI, one of the most respected names in financial data, tracked United States private equity fund returns from 2022 through the third quarter of 2025. The annualized return was 5.8%. Over that same window, the S&P 500 returned 11.6%. Half. Private equity delivered half of what a free index fund gave you and charged 53 times more for the privilege. But maybe those were just the big institutional funds. Maybe the products built for regular investors are better. They are worse. The largest private equity evergreen funds designed for retail investors, the ones managed by Apollo, Blackstone, KKR, Carlyle, and Ares delivered a median return of 11.97% in 2025. The S&P 500 returned 17.88% that same year, half the gain. All of the fees, none of the liquidity, and this is not just one data set telling one story. Watch the pattern across the institutions that know this industry best. CalPERS is the largest public pension fund in the United States, managing nearly $500 billion. Its private equity portfolio underperformed its benchmark in the most recent fiscal year. Oregon runs a $100 billion pension. Its own consultant, Makeda, flagged private equity as the single largest drag on portfolio returns in the third quarter of 2025. The state is actively cutting its allocation. Alaska's pension board was shown projections from Callan and Cambridge Associates that PE returns will trend toward just 6%. The Dutch pension giant ABP, one of the largest in Europe, has been reducing its private equity exposure for 3 consecutive years. None of them are buying more, and across the United States. Public pension funds that once rushed into alternatives are now reporting that the premium over public stocks has compressed to somewhere between 1 and 2 percentage points, barely enough to justify the complexity, let alone the fees. 6% return, a decade of locked capital, 53 times the cost of an index fund. The professionals see those numbers clearly, and one by one, they are heading for the exit. That is the backdrop nobody mentioned on Monday morning. Now here is where the math gets personal, because this is not about pension funds and their consultants. It is about you, your account, and the next 30 years. Let me walk you through what happens if even a small allocation to private equity enters your 401k. If your target date fund shifts 5% of its assets into private equity, and that PE allocation charges 1.6% instead of 0.03, your blended expense ratio rises by roughly 8 basis points, 0.08 percentage points. That sounds invisible. It is not. On a $100,000 balance over 30 years with 7% annual growth, that 8 basis point increase costs you more than $19,000 in lost compounding. If the allocation rises to 15%, which is common in large pension portfolios and exactly the range the industry is targeting, the cost climbs past $55,000. And that assumes the PE portion keeps pace with the stock market. If it underperforms by even 2 percentage points a year, which is exactly what the data from 2022 through 2025 shows, the damage doubles. Here is the conditional cascade that should keep you awake. If your plan adds private equity without your explicit consent and the fees rise by 0.5 percentage point and you hold for 30 years, and the PE allocation underperforms the index by 3 points annually, you lose more than $140,000 compared to a pure index portfolio. That is not a projection from a pessimist. That is arithmetic applied to the industry's own reported numbers. Your retirement does not lose money in a single dramatic crash. It bleeds out slowly, one invisible fee at a time, compounded over decades, buried inside a fund you never chose. Here is the deeper structural problem. Private equity makes money when it sells companies. No sale means no profit. No profit means no cash return to investors. And right now, the exit machine is broken. In 2021, PE firms sold portfolio companies worth $527.8 billion. That was the peak. By 2023, exit value collapsed to $100.8 billion, an 81% drop in 2 years. The backlog is staggering. The New York Times reports that private equity funds are sitting on 31,000 unsold companies. 31,000 businesses, valued by the funds themselves at $3.7 trillion, spread across every sector, stuck in every stage of limbo. That is not a portfolio waiting for the right moment. That is a warehouse with no buyers and a landlord still charging rent. Many of these companies have been held for a decade or longer, passed from one fund to the next through so-called continuation vehicles that restart the clock without ever returning cash to the original investors. The industry calls funds that old zombie funds the dead walking. The managers keep collecting their 1.6% management fee every year, regardless of whether a single company in the portfolio has been sold. The investors' pension funds, endowments, the very institutions this industry was built to serve, keep waiting for distributions that do not arrive. And the companies inside the funds keep aging, losing market share, losing relevance, burning through whatever competitive edge they had when they were first acquired, while the fee meter runs without pause. Here is the number that ties it all together. the last United States vintage year where private equity funds returned investors full capital, a metric the industry calls one-to-one DPI. Distributions to paid-in capital was 2016. Every fund launched after that year, 2017, 2018, 2019, 2020, 2021, has not yet paid back what it took in. 9 consecutive vintages, none of them whole. That is not a rough patch in a cyclical business. That is a structural failure in the product itself. So where does the smart money go when returns fall and exits freeze? It leaves. Global private equity fundraising peaked at $1.119 trillion in 2021. It fell in 2022. It fell in 2023. It dropped to $680 billion in 2024 and sank to roughly $551 billion in 2025, 4 straight years of decline. The longest slide since the financial crisis. Returns down, exits frozen, fundraising collapsing. The people whose entire career is evaluating private equity, the pension consultants, the endowment officers, the sovereign wealth fund analysts, are pulling their money out. The professionals are walking away, but you do not have to take my word for it. Listen to the industry itself. Hamilton Lane is one of the largest private markets investment firms on the planet, billions under management, deep ties to every major PE fund. In its 2025 mid-year outlook, the firm described the fundraising crisis with unusual bluntness. Fundraising is so difficult, it wrote, that managers are hoping the United States loosens rules for retail investors, and they can raise money from a cohort that has never heard of them before. A cohort that has never heard of them before. That is you. That is the 401k saver who has never seen a capital call notice, never negotiated a fee discount, never read a 200-page limited partnership agreement. This is not democratization. This is a customer acquisition strategy for a product the professionals are refusing to buy. They don't need your permission. They need your money. And here is what makes the comparison even sharper. 99% of state and local government pension plans already invest in alternative assets. That statistic comes straight from the Department of Labor's own proposal. So the question is not whether alternatives can appear in institutional portfolios. They already do. The question is what terms you get when you walk through that door. When CalPERS invests $500 million in a Blackstone fund, it sends a team of analysts to negotiate. It gets lower fees, sometimes half the headline rate. It gets co-investment rights with no management charge attached, quarterly reports with full transparency on every holding, every valuation method, every exit timeline. That level of access is what $500 million of leverage buys you a seat at the table where the rules are written. Now picture the 401k saver. No team of analysts, no fee negotiation, no co-investment rights. No direct line to the fund manager, and no exit clause you can trigger on your own schedule. The money enters through a target date fund wrapper designed by someone you have never met, holding assets valued by models you will never see, locked on a timeline you did not agree to. The institutions get the penthouse suite with a concierge and a view. The retail investor gets the basement with no windows. Same building, completely different experience. And nobody mentioned that distinction at Monday's press conference. If this is starting to change how you think about your own retirement account, hit subscribe. Because what comes next is the part they do not put in the brochure. Here is how the money gets inside your account without you noticing. The Department of Labor's own proposal says most new alternative asset exposure will enter 401k plans through target date funds. These are the funds that shift your mix from stocks to bonds as you age aggressive at 30, conservative at 60. They are the default option in most employer plans across America. Target date funds hold $1.6 trillion inside American 401k accounts right now. That is not a niche product. That is the backbone of the retirement system. And here is what matters. Most workers are automatically enrolled in them. Under the Pension Protection Act of 2006, employers can auto-enroll new hires directly into a target date fund without asking. You did not choose this fund. Your employer's plan selected it the day you started your job. You never read the prospectus. You never compared options. You may not even know the name of the fund where your contributions land every 2 weeks. Under this new rule, private equity and private credit can be blended into those target date funds. You will not see a line item on your statement that says private equity. You will see the same fund name you have always seen, same label, different contents. The only things that change are the fees you pay and the liquidity you lose. By the time you notice, if you ever notice, the money is already committed, and you cannot pull it out on your own timeline. You might be thinking the government would not allow something genuinely dangerous into retirement plans. That is a reasonable instinct. Regulations exist precisely to prevent this kind of risk, and they do. But this rule does not strengthen those protections. It repackages them. The proposal creates what regulators call a process-based safe harbor. If your employer follows 6 steps when evaluating an alternative investment, reviewing performance, fees, liquidity, valuation, benchmarks, and complexity, then the employer is presumed to have met its legal duty to you. Presumed, not proven, not guaranteed. That one word carries the weight of your entire retirement. It matters because the Supreme Court has agreed to hear a case filed by a former Intel employee who claims his 401k trustees made reckless decisions by putting retirement money into hedge funds and private equity. That case could rewrite the rules for every workplace retirement plan in America, and this DOL proposal landed before the court could issue its ruling. TD Cowen, a major Wall Street research firm, wrote that it remains skeptical this language will protect fiduciaries from litigation until courts have confirmed it. The safe harbor is untested. Your retirement is the test case. So let me come back to where this started and ask the question the press conference did not answer. Monday, March 30th, the Department of Labor says democratize. Blackstone's stock goes up the same afternoon. KKR's stock goes up. Apollo's stock goes up. BlackRock, which manages over $14 trillion, more than half linked to retirement, released a statement calling the rule a win for American workers. Senator Elizabeth Warren called it the opposite, a handout to Wall Street dressed in the language of worker empowerment. But forget the politicians for a moment and follow the money. If this rule is such a great deal for the buyers, why are the sellers the ones celebrating? They don't need your permission, they need your money. So what do? You do not need to panic. You do not need to call your HR department at 7 in the morning. But you need to start paying attention to your retirement in a way you probably have not before. Most Americans spend more time choosing a phone case than reviewing their 401k allocation. That was fine when the worst option on the menu was a slightly expensive bond fund. It is not fine when the menu includes locked, illiquid, high-fee assets you cannot exit on your own terms. Here are 3 numbers to track starting now. Number 1, your target date fund's alternative allocation. Every 401k plan sends you an annual fee disclosure. Starting this year, actually read it. Look for the words private equity, private credit, alternative investments, or real assets inside your default fund. If the allocation to alternatives exceeds 10%, dig deeper. Ask your plan administrator what the lockup terms are and how the underlying assets are valued. If they cannot answer in plain language, that is your answer. Number 2, your total expense ratio. This is the single most important number in your retirement account, and most people have never looked at it. Write it down today. Then check it again in 12 months. If your expense ratio jumps by more than 0.15 percentage points after this rule takes effect, you are not paying for diversification. You are funding someone else's revenue line. A 0.15% increase on a $100,000 balance costs you roughly $40,000 over 30 years of compounding. That is not a rounding error. That is a car, a year of college tuition, or 6 months of retirement income gone. Number 3, the annual scoreboard. Every January, compare the return of the largest PE evergreen funds against the S&P 500. The data is public. Morningstar tracks it. If private equity underperforms the index 3 years running, and it already has, then the entire premise of paying higher fees for higher returns is dead. 3 years of underperformance is not a rough patch. It is a verdict. They called it democratization, a word that sounds like freedom, a word that sounds like access. But democracy means you choose, and in this version, the choice was made before you heard a word about it. Your target date fund gets a new ingredient you never requested. Your fee disclosure gets a new line you never approved. Your money moves into assets you cannot price, cannot sell, and cannot understand without a law degree. And on the other side of that arrangement sits an industry drowning in 31,000 companies it cannot sell, delivering returns it cannot defend, watching professional investors walk out the door year after year and now looking through yours. You have 2 paths from here. Take control of your retirement, read every disclosure, question every fee, compare every return. Do it every single year for as long as you work, or let someone else manage it for what they call your benefit, while their stock price tells you whose benefit it really serves. They don't need your permission. They need your money. Do not give it to them by default. If this changed how you look at your retirement, subscribe. Share it with someone who has a 401k and has never checked what is inside it. Drop a comment. Has your plan already added alternatives? That answer might tell you more than any government rule ever will.